What a year. Lots of uncertainties, unknowns, and lots of new adjustments with all the changes that we saw in the economy this year. I know a lot of you are wondering what next. So in today's video, I'm going to share with you predictions on the housing market for 2023. So you want to stay tuned to find out what's going to happen next year with the housing market. Let's get started. Before we jump right into the predictions, let's look at the recent past, the current now, and then make conclusions from the recent past and the current now to see where we are headed, because ultimately the historical data is going to be our best friend and tell us where these future predictions are headed and where we are headed as an economy. So let's get started. So the recent past, when I talk about that, and I've talked about this in a lot of my other videos, but it's very important we talk about it today so we can make the best conclusions and do the best predictions for the future. So a recent past, as you all know, was the pandemic. And in that time frame from March of 2020, where lots of people lost their jobs, the economy just stopped, housing market was on a slowdown or just a complete halt till the middle of the year. And during that time, and I would say from 2020 all the way till mid of 2021, we saw that that shelter and having your own space and having a large space and just owning a home was more important than ever before with the home and work from home environment we saw there. Then we saw the Federal Reserve and the U.S. Treasury flush a lot of money in the economy, which is technically known as quantitative easing. That's when the Federal Reserve buys Treasury bonds, Treasury bills, and buys debt from the U.S. Treasury, which is ultimately what it means is they're flushing money into the economy, circulating more cash flow into the banks, and making lending a lot easier for consumers to get. And then we saw obviously that happened, lots of cash started to flow in the market, and then also, they lowered the rates very low. We saw average rates were sitting at like 2.5 at one point. So cost of borrowing was very, very low. And that resulted in very high consumer demand and increased pricing. Consumer demand, not just in real estate, but consumer demand in everything. Cars, online spending, real estate, you name it. And we've all been there, you've been there, so you saw how the consumer demand just went sky high. What that did is it caused unhealthy price growth, both in the housing industry and in the stock market. Home prices saw, in some markets, 30 to 40% year-over-year appreciation. And on the stock markets, companies like Tesla and Amazon saw a 50 to 60% increase year-over-year in stock prices, where people were just buying anything and everything because there's so much cash flowing in the market. Now, moving forward to the now, what we're seeing high interest rates, where the rates are currently right now, I'm shooting this video on December 22nd, the Feds just did the raise, another 50 basis points raise. So the rates right now are sitting at the low sixes, average rates around 6.25. They were in the sevens, but they're now down to 6.25. Now you're probably wondering, well, Feds are raising rates. They'll raise 0.75 base points, then they'll do half a point raise, which they just did. Well, why are the rates not like increasing proportionate to that? So the Fed's fund rate is sitting at around 4 something, and as they do the increase, it's not directly proportionate to the mortgage rates that you see. There are other factors that go into this. So federal fund rates is the rate that where banks trade money, or the banks borrow money at that rate. But that necessarily doesn't mean that whatever the increase the Feds do, that the rates are gonna increase directly proportionate to that. That's why rates were sitting at around maybe like 5.99, or they were around 6%, and then the Feds did a 0.5% increase last week, and we saw a little bit of a jump, because there are other factors that take into play, which is a topic for another day, but just letting you know that's why the rates don't directly proportionally increase to the Fed's funds rate. Okay, so now we got high rates, And then we have number 2, which is quantitative tightening, opposite of quantitative easing. It's a technical term. What it really means is the Federal Reserve is slowing down the cash flow of money in the economy. They're no longer buying debt. Why the Fed? If you Google the Federal Reserve and the monetary policy, what that really means is the flow of money and the governance of the companies in this country. That's what the role of the financial Federal Reserve is, and the U.S. Treasury their roles are very similar, but Federal Reserve is in charge of the circulation of the flow of money in this country, and also how banks borrow money from each other. So, anyways, the Federal Reserve has slowed down the cash flow in the economy by stopping from buying more debt from the U.S. Treasury. Okay, so now we have less cash flow of money in the economy, and what that resulted in is that we have a lower demand because people have less money now to buy. So there's lower demand there, and it's also slowed down appreciation because a lot of people are not buying homes outright, because the number one reason is the home affordability is out of reach for a lot of people. When the rates have gone from 3% to almost 6.25%, increasing mortgage payments by like 50%. So a lot of people are just outright priced out of the market. So that's why you see slow appreciation. A lot of people are not buying. But CoreLogic put out a report that said that the average appreciation that we saw in nationwide was still 10%. So we've yet to see prices drop in the housing market, but we see slower appreciation around 10% average. Now that might differ depending on what market you're in. That's just an overall average. And then number 3, we're starting to see this just in the recent weeks. We saw Tesla stock drop, we saw Amazon stock drop, and Google took a hit as well overall year over year. And I believe that that's a macro impact. What I mean by macro impact is that Federal Reserve is doing this purposefully. They're trying to slow down the economy so people start buying less and the prices of goods can come down and we can have a more normalized market. So when that happens, large companies in this country that are a big part of this economy get impacted, because now you have small, like for example, Amazon. So let's reverse real quick. When I say macro impact, so that's the main reason they're getting impacted by that, is because the Federal Reserve is slowing things down. So we saw unhealthy growth here with home prices and with stocks. So what we're seeing here when I say macro impact, first of all, a lot of it is just natural because there's unhealthy growth. It shouldn't happen. It's completely inflated. And we're starting to see those numbers starting to normalize kind of towards where these stocks were worth in 2019. That's where if you look at Amazon stock or Tesla stock, they're kind of going back to that level. And also what's impacting is the less cash flow in the economy. The cost of borrowing has gone up. So if these companies had like loans that they had gotten now, or they're trying to fund more new projects, but their cost of borrowing has gone up. So now they have to cut down on expenses. So instead of like being on thrive mode, they're more on survival mode. So that's also happening. But there are some micro effects that are happening in some of the stocks, like we saw with Tesla recently. It dropped significantly. There was some news put out there that Elon Musk is just distracted doing Twitter stuff. He's not really concerned about the company. He might be bringing in a new CEO for Twitter. And then there was some news that he's sold stock right now. But all of that could just be not mean much right now when it comes to Tesla as being a viable and a good company. Stocks are very volatile. When news goes out, that happens. So there may be some micro level or industry specific things that are also happening. But overall, we're starting to see things normalize, which we had seen unhealthy growth. Thank you for watching my content and staying connected. Like always, I appreciate you, love you all. If you're getting real value out of this video, please subscribe to my channel and leave me a comment below because I love to hear from you. So we know that the Federal Reserve is going to further increase their Fed's funds rate. There's a hike that's coming up in February and another one in March. And there's another meeting, I believe, in May. But they have made it very, very clear that they're focused on bringing the inflation number down. And the good news right now is the inflation did come down. So the changes that they have made are working. The inflation was around 9% in the middle of this year, in the summer months of this 2022. And in the report that was put out in November, the inflation was at 7.1%, a great sign. So continue to see the Fed's funds rate go up. And like I mentioned earlier in the video, that doesn't necessarily mean that the rates are going to go directly proportionate to that. The lot of lenders are adjusting their rates. So if anything, you'll see rates either stay where they're at or possibly go higher. I don't believe the rates are going to come down significantly next year. We might see small changes. Okay. And number two, I am very, very confident on this point that we may see slight rent increases throughout the country, because home affordability right now is out of reach for a lot of people in this country. So renting is going to be very popular throughout the country. So expect rents to either, depending on what market you are, to stabilize and stay where they're at, or expect some rent changes. So if you're in a lease right now, it's month to month, and you are planning to not buy for another year or two, I would look into locking in a long-term lease. Number three, inventory issues. We're going to see low inventory going forward because, like I mentioned, the Feds are going to continue to keep raising the Fed's funds rate, which is going to increase the mortgage rate. And what that's going to do is a lot of sellers are going to sit back, because now if you have to, especially sellers that are selling their primary home, because where are they going to go next to buy a home at like 6.5% or 6%? That's really going to change their scenario from where they are right now. So you will see a lot of sellers continuing to hold back unless they have to sell. So that's going to cause a inventory issue there. And then you have buyers that are just priced out of the market that just can't afford a home. So we have less buyers buying, and then just less inventory on the market because sellers are just being apprehensive. They're holding back from selling because they don't know where to go next with the high rates. And then you have, I am not believing in this whole doom gloom mentality that the economy is going to completely go to shits. I'm watching this quarter after quarter, month over month, and I feel like we're going to still see slight appreciation, especially here in the West Coast. And I'm thinking maybe a healthier 4 to 5% appreciation nationwide. And that'll probably continue next year. And I don't feel like the home prices are going to drop yet. X factors here, like again, these are predictions. There can be X factors. If we've learned anything in 2022, that's been that uncertainty is the common theme here. So anything can happen. X factors for me that I want to point out is that if there are layoffs, say on a mass level, that can be an issue there. That we have to watch the market closely and see what happens. We saw some tech layoffs happening in the months of November and the earlier part of this month. I think it's Christmas time. Things are just generally slower. Let's see what happens in January and February. But that's definitely going to be an X factor. Then the next is rates stabilizing. If the Feds do another raise in February and another one in March, and then let's say numbers come out middle of the year, and we're seeing now that inflation is, I don't know, 6%. That they're seeing that it's decreasing. There's a trend that it's going towards where they want it to go. Then I really believe that the Feds are going to stabilize and kind of hold off from doing raises. Instead of doing a half a point, they might do a quarter a point or an eighth of a point. That's what I believe may happen. Again, that's an X factor. Not sure, because right now they've clearly indicated that they're going to keep increasing the Fed's funds rate until they got inflation down to like 2%. Okay, and home prices. This is another one. A lot of people are saying this, that home prices may start to come down. Again, it's an X factor. I don't know, but if there are mass layoffs, if that happens, which I don't believe that will happen, if that happens, I feel like we have we're at 3.7% unemployment, historical low numbers right now. But things can change. So if you know that happens and the rates continue to go up, then we may see home prices come down, but we have yet to see that. We didn't see that in 2022. It's just something that we'll have to see as we turn the corner. This year has been a crazy year for all of us, but we are all in this together. As I've discussed here, my hopes are for a soft and easy landing here. And you, the buyer, the seller, you're in the market, keep your eyes open, stay alert, stay connected to your local professionals in the area. And if you are a first-time buyer that's renting and you feel like the rents are going up in your market and you're able to qualify, run those numbers with your local loan officer, your real estate agent, and find out what those numbers look like. Do the rent comparison to the buy scenario and see where you stand. Like always, I love to produce this content for you. Thank you for watching. Until next time.